Hello and welcome back. In this lesson, we are going to talk about the cash flow statement, its analysis, and the most important links between financial statements. The cash flow statement shows how a firm generates and uses cash over a period of time. It's divided into three main areas that all firms engage in. First, operating activities. It shows how much cash a firm generates and uses in its day-to-day operations. It includes cash inflows and outflows related to revenue, expenses, and working capital items. Second, investing activities. It shows how much cash a firm spends or generates through investments or divestment in its assets base. It includes cash inflows and outflows related to assets and financial investments, mainly capital expenditure. Third, financing activities. It shows how much cash a firm raises or pays out through financing activities. It includes cash inflows and outflows related to stock issuances and repurchases, debt raised, and debt repayment. Let's dig deeper by analyzing how a cash flow statement is built. The starting point of a cash flow statement is the net income from the income statement adjusted for some items. First, non-monetary items like D&A. Second, non-operating items like gains and losses from asset disposal. And third, changes in working capital. This calculation yields the cash flow from operations. By deducting capex and adding sales proceeds of long-term assets, we get the cash flow from investing. Lastly, by considering the following financing activities, such as issuances and repayments of debt, issuances and repurchases of stock, payment of dividends, we determine the cash flow from financing. The net change in cash for the period is equal to the sum of cash flow from operations, cash flow from financing, and cash flow from investing. The three financial statement documents are linked together and depend on each other. Net income, retained earnings, and cash flows. Net income from the bottom line of the income statement links to the balance sheet and the cash flow statement. On the balance sheet, it flows into retained earnings, while on the cash flow, it flows to the cash flow from operations. It's the top line of the cash flow statement. D&A, property, plant and equipment, and capex. D&A are recognized as non-monetary expenses on the income statement and get subtracted from the gross amount of the property, plant, and equipment on the balance sheet. Since they are non-monetary items, they are then added back to the net income in the cash flow statement into the operating section. At the same time, capex are added to the gross amount of property, plant, and equipment on the balance sheet and subtracting from the cash flow statement in the investing section. Also, the working capital links the balance sheet to the cash flow statement, particularly changes in working capital. Working capital is the difference between operating current assets and liability. Its change from a period to the next is reported in the cash flow from operations. Like any other asset, working capital drains liquidity when it grows and it releases liquidity when it shrinks. Interest income and expenses, financial debt, and equity issuances repayments are also related. Raising debt increases its overall amount on the balance sheet and its cost as interest expenses on the income statement. Repaying debt reduces its amount on the balance sheet and the interest expenses on the income statement. Issuances and repayments of debt and equity securities are shown in the cash flows section of financing as cash inflows and outflows. This graphic summarizes the main linkages between the three financial statements. Consider the balance sheet as the zipper connecting two consecutive income statements and the cash flow statements. The cash flow statement analysis should involve an overall assessment of the sources and uses of cash between the three main areas: operating, investing, and financing, as well as an assessment of the main drivers of cash flows. Operating activities include determining the major sources of cash flow from operations. If cash flow from operations are consistently negative, a firm needs to raise debt or issue stocks to fund these shortfalls, or to rely on accumulated cash flows from the past. If the firm has good opportunities to grow the business, cash flow from operations will be spent to invest in the business, impacting cash flow from investing. If the firm does not have good opportunities, the cash flow from operation will be returned to investors in the cash flow from financing section. Investing activities require understanding where cash has been spent or received through firm's main investments. If the firm is making major investments, it's useful to understand how it is financing these investments, through its operations or by raising external funds. Analyzing financing activities means understanding how the firm is raising capital from shareholders and debt holders and repaying this capital back. By knowing the nature of its funding sources and understanding the firm's dividend policies, we can analyze financing activities. Ideally, cash raised through a firm's core operation would be enough to cover for its investments, to support the business growing, and potentially to exceed them. The excess of cash flow from operation over capex is known as free cash flow, and it measures how much discretionary cash flow a firm's core business is generating on a recurring basis. It's computed as cash flow from operations minus capex. Depending on which perspective an analyst is interested in, asset versus equity side, there are two major types of free cash flows. Free cash flows to the firm, representing the discretionary cash flows available to all investors. It's computed without considering the debt outstanding. That's why it's also called unlevered free cash flow. It's calculated starting from the net operating profit after taxes, adding D&A, adding or subtracting the changes in working capital, and deducting capex. Net operating profit after taxes is equal to EBIT times 1 minus the tax rate. On the contrary, free cash flows to equity represents discretionary cash flows available only to equity investors. It's computed considering debt, so they are called levered free cash flow. It's calculated starting from net income, adding D&A, adding or subtracting changes in working capital, subtracting capex, and considering debt issuances and debt repayments as well. Now that you got the flavor of financial statement analysis and cash flow statement, let's test your understanding with a real-life example, the case study of Campari. Campari is one of the top companies in the world in the wine and spirits sector. You will find Campari financials, and you are required to reformulate these financials into income statement and balance sheet according to what we learned so far. Finally, you are requested to compute some ratios for Campari. Good luck and enjoy!